Kevin Warsh, the Fed chairman, was a good guy who was actually nominated by Donald Trump himself. Trump was really hoping that once Kevin took the position, he would definitely lower interest rates and implement policies that would benefit the United States. Trump even joked once, saying, "Hey Warsh, if you don't lower the interest rates, I'll sue you." It was just a joke, but on June 17th, when Kevin Warsh actually took the seat as Fed chairman, what he did was not only refuse to lower the policy interest rate, but he kept it steady at 3.5 to 3.7%. On top of that, 9 out of 12 Fed members even voted that they wanted to raise the interest rate by the end of 2026. So what now? Should we sue? Seeing this, many thought, well, I'll just wait. Donald Trump is definitely going to bash the Fed chairman on social media. But it turns out, this time, Trump's social media was calm. He wasn't mad. Why? Because inflation had gone up to 4.2%. How could the Fed lower interest rates after that? In fact, Donald Trump himself even said that. I love inflation. So now the next question has to be, is that really true, Mr. Donald Trump? Because if the Fed doesn't lower interest rates, and if the stock market crashes or takes a big hit, won't that affect your approval ratings during the midterm elections? If we dig deeper into this, I can actually answer right away that no, it won't really have an impact, because the stock market, even if it drops, it'll only drop a little. Even if it goes red, it'll just be a minor scratch, not a deep bloody red, not an aggressive red. That's because nowadays, even if the Fed doesn't lower interest rates, even if the Fed doesn't print money, even if the Fed doesn't inject liquidity into the system, someone else will step in and inject money into the system instead. And then it becomes, the outcome ends up being very similar just by changing the rules and using this keyword. Relaxing the SLR rule. Support the Try Money Monster channel by scanning this QR code. Or you can easily support our channel by liking, sharing, or leaving a comment to chat with us. And if anyone wants to support us long-term so we can keep making videos, news, and content freely like this, you can become a member. But what do you get from being a member of this channel? Honestly, you don't get anything yet. If anyone has good ideas, feel free to suggest them. But most importantly, if you haven't subscribed yet, please hit that subscribe button for us. Thank you. Let's start this video with the villain of the US economy right now. It's inflation. Because inflation is really the root cause of all the problems happening in America at the moment. So you might ask, who's the real villain causing such severe inflation? The answer is, there isn't one. There's no one who mismanaged anything. No economic missteps, no management errors at all. The only villain here is the Iran war. And what we did was sign the MOU with the suppliers. So inflation is just temporary. That's it. That's all. All right, and the next topic we're going to talk about is Kevin Warsh didn't lower the interest rate. Policy-wise, he kept the rate at 3.5 to 3.75%. Isn't that going against Donald Trump? Well, it's probably not really going against him because Donald Trump himself came out and said, I love inflation. But let's say, hypothetically, if Kevin Warsh did the exact opposite of what actually happened, like if Kevin Warsh announced a dovish policy and cut the interest rate, what would follow is that media outlets all over the world the very next day would run headlines like something straight out of a comic book saying, Kevin Warsh, the puppet said chairman, lowers the interest rate because Donald Trump ordered him to. The image wouldn't look this good at all. And besides Kevin Warsh's image as Fed chairman not looking so great, the market wouldn't look good either. Because in the government bond market, if the interest rate is cut, you can see on this chart that the yield curve jumps up day by day. If the interest rate is cut again, the yield will jump up again. How much it will jump, no one knows because it hasn't actually happened yet. But it would make the yield on the 2-year government bond, which is currently at 4.1%, surge even higher than this. The bond will be high, prices will drop, and the bond market will be on the verge of collapsing. When the bond market is about to collapse, yields will go even higher than this. As yields rise, it becomes an increasing interest burden, and that higher interest will seep into various sectors of the economy. Eventually, it becomes an interest burden for both the government and the private sector. In the end, it will hit the stock market, which will end up suffering anyway. So when inflation is still at 4.2%, you just can't cut the policy interest rate. The Fed watchers need to make sure that various economic indicators improve first, or at least decline first. But things like inflation and employment rates need to cool down before they can actually lower the policy interest rate. When that day comes, the Fed watchers can confidently say that the numbers clearly show it's the right time to cut interest rates. That would look a lot better. So let's get started. The way to bring down inflation numbers starts with what? First, there's the MOU agreement with the supplier that was just signed between the United States and Iran. That will help deal with one of the world's main villains when it comes to inflation, at least temporarily. We can take that off the table. Second, AI. Kevin Warsh once wrote an article in the Wall Street Journal saying that AI will be something called a massive deflationary force, which essentially means that AI will be able to work just as efficiently as humans, allowing companies to significantly scale back on new hiring and lower production costs. And that, in turn, helps to steadily drive down inflation. Third, there's what Kevin Warsh just announced on Wednesday, June 17th. From now on, the United States will implement a monetary policy called hawkish Fed, which will gradually decrease the overall amount of balance sheet by doing what? By reducing the size of its bond holdings. If the Fed doesn't use money to buy bonds, there will be less cash or liquidity in the system. That means the same thing as saying the Fed isn't printing money and the Fed isn't injecting money into the system. So does this make Donald Trump angry at the Fed for doing this? Yeah, does it? Why would he be mad? The answer is, even if the Fed doesn't print money or inject money into the system itself, there are still ways for money to be injected into the system. It's not really different from the Fed doing it directly. This is done by changing the rules, or the keyword I mentioned earlier, relaxing the SLR rules. I'll explain what that is in a bit, but first I have to say that the Fed has to do it this way, because the Fed, the United States Central Bank, is indeed responsible for fighting inflation, but it's not their job to crash the US markets. So the Fed's responsibility right now, in line with the US president, might be that, okay, they have to fight inflation, but they also have to deal with the debt crisis. And they must not let the government bond market collapse. And they must not crash the US stock market either. Get it? It's not easy, but it looks like they might actually be able to pull it off. All right, so the key word we mentioned is easing the SLR rule, right? Let's break it down step by step. We'll start with the process leading up to easing the SLR rule. This is what Kevin Warsh talked about at the meeting on June 17th. He said that the Fed will have a policy to reduce its bond holdings, which in other words means shrinking the balance sheet. Shrinking the Fed's balance sheet means that when bonds are issued, which is essentially debt, if the Fed doesn't buy that debt, there won't be new cash circulating in the economy. This is what people mean when they say it's not QE anymore. They're not injecting money into the system. Another thing that will happen is, if the Fed doesn't buy government bonds as usual, it's actually bad news for the government bond market, because if the Fed doesn't buy, demand will drop, right? And this will play a significant role in causing yields on long-term government bonds to rise even higher because there are fewer buyers. Normally, that's not a good thing, but this time it might actually be intentional. It could be a deliberate move to push up long-term government bond interest rates, giving banks a better opportunity to make profits. Yeah, because if you look at it, if the Fed sells bonds and that causes the yield or return on long-term government bonds to rise, it creates what's called a steeper yield curve. Look at this graph. The dashed line represents the return on long-term debt, and the solid line is the return on short-term debt. If the dashed line goes higher, it means the return on long-term debt is increasing a lot. The higher the return on long-term debt, the more pronounced this effect becomes. This gap right here, this specific gap, is exactly where banks can make a profit. Banks borrow short-term money, which has a significantly lower interest rate. See, the solid line is low, and then lend it out to the general public who usually borrow long-term. So banks make a healthy profit from this interest rate gap. If you're wondering what this looks like in practice, let me explain it further. Banks already borrow short-term money, but if you ask what regular people borrow from banks for, most of the time it's for big things like mortgages or car loans, right? Those are long-term loans. So the way banks make a profit is by borrowing short-term money at the lowest possible interest rate and then hoping that the long-term interest rates they charge on loans are as high as possible. So banks make their profit from this gap, right? Does that explanation make sense? On the other hand, with a steeper yield curve, let's say the short-term yield, which is the solid line, isn't low, or the long-term yield, which is the dashed line, isn't high, then the gap becomes narrow. If the gap gets really narrow, it means banks can make less profit. Or if the short-term yield actually exceeds the long-term yield, then if banks lend out money, they'll end up losing money. If something like this happens, it becomes significantly more difficult for banks to lend, or they might not lend much at all. Now, back to the point. If the Fed reduces its bond holdings and that causes the yield on long-term government bonds to increase, then banks will have more opportunities to earn returns and generate higher levels of profit. This would naturally encourage banks to actively seek to lend more money. So let's move on to the next plan for easing the SLR. What is SLR? SLR stands for Supplemental Leverage Ratio. It's a rule that was established after the 2008 crisis, requiring banks to hold assets as a buffer compared to the bank's total assets. And within that ratio, there must be treasuries or government bonds included. However, under the SLR rule, they don't allow banks to hold treasuries without limits. There are specific regulatory limits on how much treasuries or government bonds a bank can hold. It's certainly not unlimited. In a bank's total assets, there are a wide variety of different components. For example, suppose a bank has loans, which are the money it lends out, plus repos, which are short-term borrowings between banks, plus reserves or reserve assets. Whatever amount of capital is left over after that is what can be allocated to holding government bonds. That's essentially how it works. Actually, there is a complex formula to calculate it, but honestly, I'm not particularly skilled at performing those calculations. At this point, when I was reading, I wondered, why do banks want to buy government bonds so much that there needs to be a limit? If there were no limit, would they really buy that many? So I looked it up, and the answer is that government bonds are actually a favorite of banks. First, they're as liquid as cash, super flexible. Second, they can easily be used as collateral for loans, and they're considered really good collateral too. So if there are any relaxations, the SLR, which sets a limit on how much government bonds banks can hold, says banks can't hold more than a certain proportion. If those rules are relaxed and banks are allowed to buy more bonds, or if they can buy as much as they want, that would basically be hidden QE. It's like injecting money into the system without making a big announcement, at least not technically. But actually, it could be a big deal, because even if the Fed says it's reducing its bond holdings, if the Fed relaxes the SLR, then it doesn't have to be the Fed buying the bonds. Commercial banks can do it instead. So in the end, the effect is pretty much the same. When there's debt, meaning bonds are issued, if the Fed doesn't buy them, then no new money enters the economy, right? But if the banks buy them, then money is injected into the economy anyway, without the Fed having to do QE. Simply put, it's a way of doing QE that doesn't come from the Fed, but instead it's QE coming from commercial banks. Pretty wild, right? With this method, the Fed can just say, hey, we're not injecting money, we're not printing money, we're actually reducing our bond holdings, we're shrinking the Fed's balance sheet, we're being hawkish and fighting inflation, and then they just let the banks compete to buy up the bonds. As a result, the money flows into the system from the banks instead. And when the banks are the ones purchasing and acquiring the bonds and absorbing all those treasuries, the Fed can reduce its own balance sheet. What happens then is that the commercial banking sector grows, and the end result for the market ends up being essentially the same. Instead of the Fed printing money and injecting it directly into the system, let me sum it up simply. By just changing the rules and relaxing the SLR, the Fed can basically say it's still running a hawkish policy to fight inflation, while the capital markets won't crash because money is flowing in from commercial banks. And the bond market won't collapse either because it's the commercial banks that are buying. The economy can keep growing because banks can profit from lending. So banks are likely to lend even more, and the commercial banking sector will just keep getting bigger and fatter. It's a win-win situation. And all of this means that, hey, when it comes to Donald Trump's midterm elections, the market probably won't tank badly. If it does go down, it might just be a minor scratch, nothing aggressive. Or who knows, it might even go up. So it probably won't affect the vote count that much. So the next question is, hey, does that mean this method is actually good? The SLR thing seems like a win all around. Has it ever been done before? Yes, it has. Back during the COVID period in 2020, the Fed excluded treasuries from the SLR calculation, basically relaxing the SLR temporarily for 1 year. What happened then? Take a look at this graph. See? Banks immediately poured money into buying treasuries, and their holdings of treasuries shot up right away. With banks increasing their holdings of treasuries, what happened to the bond market? If you look at the bond market graph from that time, yields dropped beautifully. Yields went down, bond prices went up. Wow, the bond market loved it. This really answers the question of why banks were holding so many government bonds during that period. And then in 2021, as I mentioned, the relaxation was only temporary for 1 year. When the SLR relaxation expired, the bond market, which had previously seen yields drop and prices rise beautifully, started to move in the opposite direction. After that, yes, yields gradually began to rise again, and prices started to fall from 2021 onward. Until we get to 2023, what happened then? Does anyone remember? The banks started collapsing, right? It began with Silicon Valley Bank. And then within just 48 hours, Signature Bank collapsed right after, followed by First Republic Bank and then Silvergate Bank. So are there other factors that caused the collapse? There are actually quite a few, but one of the main reasons for the collapse was holding bonds. Because since 2021, bond yields have surged. The 2-year bond yield jumped from 0.2% to 5%. The 10-year government bond yield went from 1.5% to 4%. And when yields go up, prices drop, right? That's right. Bond prices dropped by 20 to 30%. So when the assets that banks hold, meaning bonds, fall in value by 20 to 30%, what happens? It leads to what's called an unrealized loss or an accounting deficit. Normally, if you don't sell, it just stays as an accounting deficit and isn't really a problem. The problem is that investors see this and think, whoa, the bank has such a huge unrealized loss. That's not good. I'm going to withdraw my money. And once people start to realize this and a group of people begin to withdraw their money, then other groups follow suit. Eventually, even bigger groups rush to withdraw their money, leading to what's called a bank run. This continues until the bank collapses. When people rush to withdraw their money like that, what used to be an unrealized loss, if you didn't sell, it wasn't a problem, ends up having to be sold. And once it's sold, it's no longer unrealized. It becomes a real loss, a real deficit, to the point where the bank actually collapses. This is something that happened in the past. I'm not saying it will happen again. I'm just sharing what happened back when they did something like this and what followed as a result.